What are you doing to reduce your taxes before this year ends? In this episode, I'm going to give you the top 4 tax strategies that you may be able to use to reduce your taxes immediately. As a licensed CPA that tax plans every day at mycpacoach.com, I have used some of these simple strategies to save my clients tens of thousands and sometimes hundreds of thousands of dollars in taxes. And today you are going to learn them for free. So go ahead and save this video, drop a comment below with your thoughts and questions, and let's go ahead and jump right into it. All right, so before you implement any tax strategy, you need to know your marginal tax rate for that year. And a lot of people don't. So go ahead and take a look at this chart for 2024's tax rates and make note of the top tax bracket your income falls in. Now, this rate will help you understand the value of tax strategies you implement or deductions you create. For example, if you are in the 32% tax bracket, that would mean that you would save 32 cents on every dollar you find in additional tax deductions. So if you found $100,000 in tax deductions, you would save $32,000 in taxes, or $24,000 if you're in the 24% tax bracket, and so on. Now, of course, your tax bracket may also decrease depending on your exact income and the amount of deductions you take. But my overall point here is that your tax rate matters. The higher your tax bracket is, the more money these strategies will save you in taxes. And the lower your bracket is, the less money you will save, and you will need to evaluate if these things make sense for you. With that said, let's go ahead and jump into these tax strategies, starting with the easiest things to do first. Strategy number 1, max out your traditional IRA. Now, this is the most traditional way to reduce your taxes, but it is very easy to do and is still very effective. So every dollar you move into a traditional IRA is tax deductible and will reduce your taxes immediately if you qualify. Now, if you do not know, an IRA just stands for Individual Retirement Account, and you do not need a business or an employer-sponsored plan to set this up. All you need is earned income. And if you have that, you can put up to $7,000 of it into your traditional IRA for 2024, or $8,000 if you're over the age of 50. Now, if you are covered by a workplace retirement plan through your employer or through your business, like a 401k plan, for example, you may not be entitled to the full IRA deduction depending on your income. For example, single taxpayers with incomes above $87,000 and married filers with incomes above $143,000 will receive no tax deduction for their IRA if they are covered by a retirement plan at work. However, this also means that if you're not covered by a plan and your spouse is not covered if you file jointly, you can write off the full amount that you put into your IRA up to the contribution limit. So let's say you are single and your employer does not offer a 401k or any other retirement benefit, then that would mean you could take $7,000 of your income, put it in a traditional IRA, and receive a $7,000 tax deduction on your tax return, which would save someone in a 24% tax bracket about $1,700 in taxes, or $3,400 if they are married and both taxpayers use this and are not covered by a retirement workplace plan. Now, with that said, many people are in fact covered by workplace retirement plans. So let's go ahead and talk about how you can use those plans as well to reduce your taxes immediately. Strategy number 2, max out your traditional 401k. So a 401k is very similar to an IRA, except the fact that number 1, it is set up through a business, whether it be your own business or an employer. And number 2, your employer or business can also fund the plan in addition to what you put into it. So basically, a 401k is just an employer-sponsored retirement plan. With that said, let's talk about how much money you can put into it to immediately reduce your taxes. So for the 2024 tax year, you could put up to $23,000 of your wages into a traditional 401k, or $30,500 if you're over the age of 50. And your employer or business could put up to another $46,000 into the plan, depending on the plan design, like the employer match, your income, and so on. which also means that if you're self-employed, you could benefit from both sides of these limits: the employee deferral limit of $23,000 and the employer match of up to $46,000, allowing you to put up to $69,000 towards your retirement in one given year. Or if you're over the age of 50, you could get up to $76,500 into your account. Now, I have several videos about retirement plan structures on this channel already for you that cover things like SEP IRAs, simple IRAs, solo 401ks, pension plans, and so on, that will assist you in doing this. So make sure you subscribe to our channel to learn more about that. But outside of that, I have to tell you that the decision to use either a traditional 401k or IRA instead of a Roth should be weighed heavily and also take into consideration your marginal tax rate. For example, at our firm, we usually do not recommend traditional retirement accounts until our client's tax bracket is north of 20 to 30%, because that's when these deductions will be worth more to you. So someone in a relatively low tax bracket like a 10% or 12% bracket may benefit more from using a Roth retirement plan, which does not actually give you a tax deduction up front, but instead provides you with tax-free income when you withdraw these funds from your investments when you retire. Now let's talk about some strategies that do not involve your retirement. Strategy number 3, max out your health savings account. Now, this is a tax strategy that is not used enough and arguably has twice as many tax benefits as an IRA and a 401k. So let's break this down. A health savings account, or HSA, is basically a savings account for qualified medical expenses, which includes medical, dental, vision, and many more health-related expenses. So this would include payments you make to doctors, dentists, chiropractors, psychologists, therapists, and even payments you make towards certain weight loss programs. Plus, on top of this, there are a variety of health and wellness products that you can use your HSA to pay for. For example, Amazon has an entire portion of their website dedicated to HSA eligible purchases that would allow you to buy things like health supplements, over-the-counter medicines, eyewear, and so much more. So the idea here is that instead of paying for these types of expenses out of your pocket and not receiving a tax deduction, to instead use your HSA to pay for them, and therefore you would effectively receive a tax deduction for these expenses when all is said and done. Now, there are 3 primary tax advantages associated with using an HSA. Number 1, the money you put in it is tax deductible. Number 2, investment earnings that accumulate in the account are deferred. And number 3, when you use those funds for qualifying medical expenses, those funds come out of your HSA tax-free. So unlike a traditional IRA or 401k that just gives you a tax deduction but triggers tax when you withdraw those funds when you retire, and unlike a Roth that gives you tax-free income when you retire instead, but no tax deduction when you fund it, an HSA gives you both of these things: a tax deduction when you fund it and tax-free withdrawals when used correctly. Now, to qualify for a health savings account, you must have a high deductible health insurance plan, which is defined as having a plan with a minimum deductible of $1,600 for individual coverage and $3,200 for family coverage. And by the way, if you don't know what your deductible is, just look at your health insurance card, and usually you can find the deductible on the front or back of that card. Now, if you qualify, you can put up to $4,100 or so if you have individual coverage, or up to $8,300 if you have family coverage. And if you're over the age of 55, you can also put an additional $1,000 into your HSA and receive that as a tax write-off to reduce your taxes immediately. Strategy number 4, maximize your tax deductions with Section 162 of the Internal Revenue Code. Now, this provision opens the door for you to write off almost any expense that you have that meets its criteria. It specifically states that you can deduct all ordinary and necessary expenses paid or incurred in carrying on any trade, or business, which means that if you own a business, earn 1099 income, work as an independent contractor, day trade, or have an income generating side hustle or side gig, you may qualify to take tax deductions under this provision. So in addition to the standard deduction or the itemized deduction, this would allow you to take over 100 additional tax write-offs on your return, many of which may already apply to expenses you already have. For example, a lot of my clients pay for health insurance or some portion of it, but many of them are not deducting that as an expense on their tax returns. Well, under Section 162 of the tax code, they can. The same also applies to home expenses. Most people who work from home do not write off any portion of their home expenses on their tax returns. However, under Section 162, they can write off the business usage of their home with the home office deduction. You can literally write off everyday expenses like your travel, vehicles, dining, housing, childcare, and so much more if you can associate a business purpose with those expenses. Plus, on top of all of this, there are even more advanced strategies that you can take advantage of with the tax code. For example, you can rent your home to your business and charge it a fee. Under the Augusta rule, the fee will be tax deductible for the business and tax-free to you. You can also hire your kids or your parents under your business. And if they earn less than $14,000 in income, that income will be tax-free to them and tax deductible for the business. Plus, in some cases, it may even make sense to hire your spouse in your business. But outside of that, you can also avoid other forms of taxes like Social Security and Medicare taxes by optimizing your entity structure through the use of like an S corporation or a C corporation. Now, if you want to learn more about this, I am going to publish an in-depth video guide that goes into greater detail with these exact tax strategies. So make sure you subscribe and turn on notifications to get it as soon as it drops. And by the way, if you're interested in working with a CPA that can help you implement these tax strategies as soon as possible, just apply to work with one of my CPAs today at mycpacoach.com.